Hello everyone, welcome to EduTap and welcome to PFRDA and IFSCA Grade A Mega Concept Revision Series, where today we are going to understand and we are going to revise different concepts with respect to finance with the help of MCQs. And what I want you to do, I want you to be a part of this session, and when I will be displaying the questions on the screen, I want you to participate and you can tell me that what do you think is the correct answer with respect to the question. Fine, but before we begin all those kinds of things, please confirm in the chat box whether I'm audible to all of you or not. If my audio, video, everything is fine, just write yes or no as a part of the chat box so that I can begin. Okay, I think there is no problem with the audio and video, and let us begin. Let us begin. Let me display the questions on the screen, and I expect each and every one of you to answer and to participate. So let us start. So basically this is question number one, and the question number one is Indian government decides to issue bonds in yen so as to raise money from Chinese people. These types or bonds are called option A external commercial borrowings, option B corporate bonds, option C sovereign bonds, option D term bonds, and option E serial bonds. So what do you think is the answer with respect to the question? What do you think is the correct answer? Yes, great Nilesh. So basically the correct answer regarding this question is going to be the C option, because we know that when we talk about sovereign bonds are the type of bonds that are issued by the government. Fine. Now even if I remove Indian from here, if I add US, French, Chinese, whatever it is, if the bond has been issued by the government, then the term that we use in order to indicate it is basically the sovereign bond. Fine. And why basically government issues sovereign bonds? The purpose is that basically the government issues sovereign bond in order to attract money. Fine, in order to attract money so that basically they can expend that money in order to promote the economic development of the country. So that is basically is the, I would say, idea behind the sovereign bonds. And I would say rest of the options are easy to eliminate. For example, we know that external commercial bond borrowings are not a type of bonds, they are type of loans. Corporate bonds are issued by corporates. Fine, and we know about terms and the serial bonds also. Fine, they are opposite to each other with respect to their maturity. Fine, where term bonds have to be given in a single maturity, and whereas if we talk about serial bonds, they have different types of maturities. They have different, or I should say multiple maturities. So that is something is going to be the answer. So I would say C is going to be the answer with respect to this question. Now moving on to the question number 2. If the government of India increases interest rates, the likely effect on bond prices would be: option A, the price will fall; option B, the price will rise; option C, prices are not linked to interest rates; option D, cannot be predicted as it depends on the fiscal deficit of the government; and option E, none of the above. So please mark the answer with respect to question number 2. Let me see your answers. Yes, as Nilesh has written, yes, A is going to be the answer with respect to this question. The price will fall. Why the price is going to get fall? Because basically when the new bonds are issued in the market, or I should say if the interest rates get increased in the market, fine, so what is going to happen? The new bonds that are issued with respect to this high interest rates, they are going to become more attractive, and since they have become more attractive, so their demand in the market is going to get increased. Whereas if we talk about the previous issued bonds or the existing bonds, since they are offering lower interest rates, so they are going to become unattractive, and since they have become unattractive, so basically their market price is going to get fall. Fine, and this is something that has been asked with respect to the question, so the price is going to fall in this scenario. So A is going to be the answer with respect to this question. Now moving on to the question number 3. A dash market is a market through which buyers and sellers trade gold, silver, as well as associated derivatives. So shine market, metal market, jewelry market, bullion market, or all the above. So question number 3, mark your answers. Question number 3. What is going to be the answer to this question? Yes, as everybody is writing, it is going to be the Bullion market. Very easy question, I would say. And if you will see the PFRDA previous year questions, also a lot of easy questions are also being asked as a part of the examination. So not all questions are difficult. Fine. So if you talk about shine market, it is no such financial term, and you can easily eliminate it. If you talk about metal market, it is a broader term. Fine. But whereas if you talk about the jewelry market, it basically deals with the ornamental market that is there. And if you talk about bullion market is very specifically linked to the precious metals that are there. For example, the gold, the silver, fine, and other such kind of associated derivatives. So that is why D is going to be the answer with respect to this question. Now moving on to the next question, which is question number 4. A derivative's value dash during the life of the derivatives contract. So it increases as the expiry date approaches, it decreases as the expiry date approaches, it fluctuates with the spot price of the underlying asset, it remains fixed, or none of the above. So what do you think is going to be the answer to this question? Question number 4. Let me see your answers. Yes, as everybody is writing, C is going to be the answer to this question, because we know that when we talk about derivative, the value of this derivative is derived from the value of an underlying asset. So the thing is that we talk about the value of a derivative, it is not fixed. So it fluctuates with the value of that certain underlying asset with which its value from which its value has been derived. So that is why basically the value of the derivative is going to fluctuate with the spot price of the underlying asset. But let me also tell you that it is not the only factor that is going to fluctuate the value of the derivative. There are other factors also. For example, it can be, I would say, volatility in the market, it can be interest rates also, fine, and it can be the time also with respect to the expiry. Different kinds of things can be there that can basically fluctuate the value of the derivative. And I would say the spot price of the fluctuation in the spot price of the underlying asset is also one of them. Fine, very importantly. Now moving on to the next question, which is question number 5. Currency and interest rate derivative markets are regulated and supervised by dash. Currency and interest rate derivative markets are regulated and supervised by dash. Option A, SEBI. Option B, FIMDA. Option C, Finance Ministry. Option D, RBI. And option E, jointly by RBI and SEBI. So question number 5. Yes, I'm seeing your answers. Yes, as Nilesh has also written. So the answer to this question number 5 is going to be the E option. Fine, it is regulated by both, I would say, RBI as well as SEBI. So I would say primarily it is regulated by RBI if we talk about currency and interest rate derivative market. But when these, I would say, the interest rate derivatives, they get exchanged. Fine, so that exchange is under the purview of SEBI. So that is why we say that it is jointly regulated by RBI and SEBI, and E is going to be the answer with respect to this question. Now question number 6. Question number 6 is, following institutions can take part in the call money market except. Now option A, scheduled commercial bank. Option B, regional rural banks. Option C, all primary dealers. Option D, payment banks and small finance bank. And option E, land development banks. So mark your answers for the question number 6. Yes, everybody. Question number 6, mark your answers. Okay, Marcus is writing D. Nilesh is also writing D. Anyone else who would like to participate? Fine. So basically, with respect to this question, the answer to this question is the E option, not the D. Payment banks are basically, they are permitted basically to participate in the call money market. Fine, they are allowed, and they are permitted. Fine. If we talk about land development banks, they are basically, I would say, long-term cooperative banks, and their main purpose is with respect to the agriculture development. Fine. They provide agriculture development loans, and they are not somebody who would like to participate in the short-term liquidity, because we know that call money market is what it is. It is for the management of the short-term liquidity with respect to the different types of banks. But if you talk about land development banks, they are long-term cooperative banks. They basically provide loans, they provide lending, they deal with the money in a as a long-term perspective. Fine. So they don't deal with the short-term liquidity primarily, and that is why they are not permitted to participate in the call money market. So that is why E is going to be the answer with respect to this question. I hope it is pretty much clear to all of you why land development bank is the answer to this question, and I hope you also know what is call money market. Now let us move on to the question number 7. What is the minimum value for certificate of deposits? What is the minimum value for which certificate of deposits can be issued? 1 lakh, 2 lakh, 3 lakh, 4 lakh, 5 lakh. Question number 7. Very straightforward question. Yes, as everybody is writing, it's a very easy question. It's 5 lakh rupees. Fine. So the answer is 5 lakh rupees with respect to certificate of deposit. And I hope you know what is for certificate of deposit. I have added the screenshot over here, and you can read it from there. That what do you mean by certificate of deposit? And I'm expecting you to know that, because it is a very, I would say, easy topic as far as your syllabus is concerned. Fine. So you are going to cover this topic if you are completing the syllabus. So that is regarding the certificate of deposit. Now moving on to the question number 8, which is regarding finance commission. The finance commission recommendations for devolution of taxes are based on which of the following principles? Option A, equity and efficiency. Option B, investment and savings. Option C, consumption and production. And option D, export and import. So mark your answer for the question number 8. Yes, I'm seeing your answers. Question number 8. The principles behind devolution of taxes with respect to finance commission. Yes, so the correct answer to this question is going to be option number A, which is equity and efficiency. Basically, equity ensures that whatever resources, or whatever I would say resources have been distributed to the different states, they are distributed based on a fair manner and on the basis of merit. Because we know that if we talk about India, different states have different demands. Some states they are doing well, some states that are there as a part of our country, they are underperforming, and they require, I would say, more demand in terms of fund from the central government. So based on that, basically finance commission ensures that certain set of those demands based on the equity are also basically met as a part of the devolution criteria. Fine. And if you talk about efficiency, efficiency means whatever taxes that have been devolved from the central government to the state government, they have been used in a efficient manner. Fine. So the resources are optimized and are used in a efficient manner, so that basically we can create more productivity, better output, and that can contribute to the overall growth and development of the nation. So both equity and efficiency are the primary criteria that are taken into consideration with respect to the devolution of taxes, the recommendations that are given by the finance commission. I hope you know about finance commission also, the constitutional body. Please read about finance commission. What is finance commission? Who appoints finance commission? What is the tenure of finance commission? What are the functions of finance commission? Fine. And you should also know that whether the recommendations of the finance commission are mandatory to be followed by the government or not. So write it in the chat box. Are they mandatory? Whatever the recommendations of the finance commission are they mandatory for the government to be followed? Because it is a topic that is given in your syllabus. Right? Yes or no? Are they mandatory to be followed? Fine. So they are, yes, as Nilesh is writing, they are not mandatory. Fine. It is up to the government that what recommendations they want to follow and what recommendations they do not want to follow. It is advisory in nature, and the government can skip any recommendation also if the government sees that if does not fits in the objective of the government, it does not align with the objective of the government in the at the present time. So the government can avoid that kind of recommendation too. So it is just advisory in nature. It is not mandatory to be followed by the government. Now moving on to the question number 9, which is regarding the inflation. So inflation can lead to decrease in the purchasing power of money. Inflation can benefit lenders with fixed rate debt, and inflation can cause uncertainty and reduce long-term investment. So tell me, what is going to be the answer with respect to question number 9? So let me see your answers. Yes, so the correct answer with respect to question number 9 is going to be the B option. Why B option? Because if we talk about the first option, this is very much, I would say, straightforward, that inflation leads to decrease in the purchasing power. The answer is yes. Of course, it leads to decrease in the purchasing power, and the individual's capacity to purchase things from the market, it get decreased. Fine. If we talk about point number 3, so okay, yes, so this is basically the correct option, so it get decreased. If we talk about point number 3, which says that inflation can cause uncertainty and reduce long-term investment, this is also true because inflation leads to a lot of uncertainty. So different individuals, different businessmen that are there, they refrain from doing long-term investment in our country or in any country where the inflation is rising. The second option, inflation can benefit lenders with fixed rate debt. This is the incorrect one, because basically inflation, when the inflation increases, basically the borrowers get benefited and the lenders, they suffer the loss. Why is it so? Because let us say there is a person, he is a lender, fine, and this person Y, he is a borrower. Now this person X has lended the money to the borrower, let us say at the interest rate of 5%, and let us say the inflation eventually increases to 7%. Now the rate of the inflation in the economy is higher than the interest rate with which he is going to receive back his money from the borrower after maybe 1 year. Fine, let us say within this 1 year the inflation got increased and it is more than 5%. So what is going to happen with the lender? Don't you think that it is going to be a loss case scenario for the lender? The answer is yes, it is going to be a loss case scenario. But let us say the opposite happens. Fine, let us say the deflation happens, the inflation falls down. Now let us say the inflation is 3%. Now what is going to happen when the inflation falls down? In this case, who is going to get benefited? It is the case is going to get reversed. Now if the inflation falls down, then over here the lender is going to get benefited and the borrower is going to suffer. He is going to face the loss. So this is a scenario that happens in case of inflation and deflation. Fine, I hope it is pretty much clear to all of you. Now moving on to the next term, which is question number 10. So which of the following is not a function of the RBI? Regulating the banking sector, issuing currency, managing foreign exchange reserves, implementing fiscal policy, acting as a banker to the government. So tell me, what is going to be the answer to this question? Which of the following is not a function of the Reserve Bank of India? Yes, as Nilesh has written, D option. Why D option? Because all these functions that we have seen over here, they are, I would say, they come under the purview of RBI, under the roles and responsibilities that are played by the RBI. But this one, when we talk about fiscal policy, it is the function of the government. Fine, the government uses fiscal policy to the tools like expenditure, fine, or you can say spending and taxation. And using that, what the government does, government basically controls the money supply in the economy, and through this it basically influences the economic development and addresses issues like unemployment. Fine, so that is basically how the government uses fiscal policy tools in order to address the economic development concerns. And this is something, the implementation of fiscal policy is the function of government and not the RBI. RBI deals with monetary policy and not the fiscal policy. And I hope question number 10 is clear to you. Question number 11. Consider the following statement about the GST in India. So GST is a single tax on the supply of goods and services right from the manufacturer to the consumer. GST in India is levied on the central level only, at the central level only, and GST has subsumed various indirect taxes such as VAT, service tax, excise duty. So please tell me the answer with respect to this question. Question number 11. A, B, C, D or E? Yes, very good, Nilesh. So B is going to be the answer to this question. Why B? Because the second statement is incorrect. We know that GST is a destination-based tax and it is a single tax that is basically apply, at the all India level and right from the manufacturer to the consumer. Fine, this is how it basically deals with the supply chain. And we know that since it is a type of all India single indirect tax, so it's some subsume different type of indirect taxes like VAT, service tax, and excise duty. But GST is a type of all India tax, but it is not that it is levied at the center level only. It is levied at the state level also, both center and state, and that is why we have CGST, we have SGST, and we have IGST also. Fine, which basically implies that it is levied at both central as well as the state level, which means the intrastate level also and the interstate level also. This is something that the GST deals with. I hope it is clear to you, and B is the answer to this question. Now moving on to the next thing. The next is question number 12, which is regarding Nidhi companies. So tell me about Nidhi companies. Nidhi companies are regulated by which of the following? Nidhi companies are regulated by which of the following? So basically, if we talk about Nidhi companies are a type of NBFCs. Fine, we know they are a type of NBFC. A key feature regarding Nidhi companies is that they basically accept money, or you can say accept deposit, and they lend deposit to the members only. Fine, this is a very important key feature. And who basically regulates Nidhi companies? It is regulated by whom? Question number 12. Marker is writing D, Nilesh is writing C. So basically C is the answer to this question. Marker, it is not D. D is not the answer to this question. It is a C. It is regulated by Ministry of Corporate Affairs. If you want to know about state government, you must have heard about you must have heard under NBFCs about chit funds. Fine. Chit funds are something that come under the purview of the state government, not the Nidhi companies. Nidhi companies are under the Ministry of Corporate Affairs. Fine. So that is, I would say, the key idea. Now there are other type of features also that you can read later on. For example, what are the limitations that are there with respect to Nidhi companies regarding borrowing and lending? Also sort of things, also different type of features are there with respect to Nidhi companies that are recognized under the Companies Act 2013. Now moving on to the question number 13 regarding cess and surcharge. So cess is an additional tax levied on the basic tax liability to fund specific government projects, whereas surcharge is levied as a percentage of the income tax payable and varies based on the income slabs. Both cess and surcharge are levied uniformly on all taxpayers regardless of their income levels. So tell me the answer with respect to question number 13. Yes, I can see your answers for the question number 13. Nilesh is writing E. What about Marcus and others? Marcus is writing D. Okay. So which of the following are correct? So basically, with respect to this answer, the correct answer is going to be the A option, neither D nor E. Why A option? Because of course we know that cess is an additional tax on the basic tax liability. This is a keyword. Fine, basic tax liability. So whatever your tax is, without any kind of additional charge or additional fees, whatever basic tax you are paying to the government, based on that basically you are going to pay the cess. For what purpose? For specific government projects. For example, you must have heard about education cess. Fine, you must have heard about Swachh Bharat cess. Different type of cess are there. Now if you talk about surcharge, surcharge is paid on what? It is based on, it is levied as a percentage of income tax payable, which basically means that the total tax, including all fees, all charges that are there, the total tax that is there, that is you are going to pay to the government. Based on that, the surcharge is calculated, and surcharge is there, it is basically based on the income tax slab of the individual. It is imposed on the income tax slab of the individual, which basically means that the surcharge is going to vary for the individuals who belong to different type of income slab. So the person who is going to earn the higher income above a certain threshold is going to give higher surcharge, unlike the other person who is going to give the lower surcharge. And that is the reason why C option is incorrect. Why? Because the C option says that C option says that both cess and surcharge are levied uniformly on all taxpayers. That is not the scenario, because when we talk about surcharge, since it is imposed on the income slab, and that is why surcharge is not going to be uniform, because the income of the individual is going to vary, and those who are paying higher income tax as a part of their income, they are going to pay higher surcharge. So that is how it works. So basically it is also saying regardless of the income level, that makes it more incorrect. Fine. So basically C is going to be the incorrect option and A is going to be the correct answer to this question. Fine. I hope it is clear to all of you. Now moving on to the question number 14. Which of the following is not a fiscal policy tool? I would say very easy question. Which of the following is not a fiscal policy tool? A. Government spending. B. Taxation. C. Public debt management. D. Interest rate changes. And E. Subsidies. So which of the following is not a fiscal policy tool? Question number 14. Mark your answers quickly. Question number 14. Yes, very good, Marcus. So basically D is going to be the answer to this question. Yes, Nilesh has also given the correct answer. So why is D is the answer to this question? D is the answer because interest rate changes are not a fiscal policy tool. It is basically a monetary policy tool. We know about fiscal policy tool. Fiscal policy tools includes the government spending and the taxation. Fine. Now see, option number A is under the spending, so it is going to be a fiscal policy tool. B is under taxation, it is going to be a fiscal policy tool. Now using the fiscal policy, what the government does, for government basically decides that how much it is going to spend and how much it is going to basically what is going to be basically the tax that is it is going to charge from the people. Fine. So basically why the government is using this fiscal policy tool, it is using so in order to manage its debt, so that basically it can manage its expenditure and the receipts. Fine. So that is why basically public debt management can also be considered as a tool of fiscal policy. And lastly we have the subsidies, because subsidies are what? Subsidies are a type of expenditure, subsidies are a type of spending from the side of the government. Government is providing subsidy for the social welfare, and since it is incurring cost to the government in order to provide the subsidy, so that is something, it is again that will come under the purview of the fiscal policy. But when we talk about interest rate changes are something that are not under the hands of the government. Who decides the interest rates? It is basically the RBI, and that is why D is not going to be the answer to this question, and that is why D is sorry, I would say D is not going to be a part of the fiscal policy tool, and that is why, since it is asking about not, so that is why D is going to be the answer to this question. Fine. So I hope it is clear to everyone. Now the last question for today, question number 15. Which of the following acts as an automatic stabilizer in fiscal policy? Automatic stabilizer in fiscal policy. Tell me. Automatic stabilizer in the fiscal policy. A. Fixed interest rates. B. Export subsidies. C. Progressive income tax. D. Government borrowing. And E. Foreign direct investment. For the question number 15, mark your answers. Question number 15, mark your answers. Very good. Anyone else? Nilesh, what's your answer for the question number 15? See, when we talk about automatic stabilizer, what is the purpose of automatic stabilizer? Automatic stabilizer, जैसे नाम से पता चल रहा है, it means it is automatically stabilizing the economy. Now, what do we mean when I say that it is automatically stabilizing the economy? It means that it is stabilizing, it is creating a balance in the economy without any kind of intervention from the side of the government. सब कुछ ऑटोमेटिक हो रहा है, सब कुछ खुद हो रहा है, बस गवर्नमेंट ने पॉलिसी इंप्लीमेंट कर दी है और उसके बाद सब कुछ खुद ही होगा. The government does not have to interfere again and again. That is what we understand by the automatic stabilizer. Now, as a part of this question, what is going to be the answer? C is going to be the answer to this question. Why? Because progressive income tax is something, let us say there is a economy, fine, there is a country, and as a part of it the government has implemented the progressive income tax. Progressive income tax basically means those individuals who have higher income, they are going to pay more tax, and those individuals who have lesser income, they are going to pay less and the lesser tax. Fine. So that is the idea. So for example, let us say if the economy is going through the boom period matlab the economy is witnessing higher economic growth. Now when the economic growth and development happening in the economy, don't you think that at some point of time it is going to give rise to the inflation also? The answer is yes. When the development happens, people have more money in their hands. But when people have more money in their hands, they will go to the market in order to do the spending. So the demand of the goods and services in the market is going to get increased. When the demand of the goods and services in the market is going to get increased, don't you what do you think is going to be the scenario with the prices? When the demand increases, the prices are also going to get increased, and this is a result of what? This is a result of the economic growth, due to which people have more money in their hands, and this is something, a repercussion of, I would say, the development. Now when the boom period is happening, this is the scenario that can happen. This is the problem that can arise in the economy. Now just imagine that the government follows this policy of progressive income tax, which basically means that if the economic development is happening and people are having more money in their hands, what does it mean? It means that if the progressive income tax policy is there, government does not have to do anything. जैसे ही लोग के पास एक्स्ट्रा पैसा आया, the moment people got extra money in their hand, automatically they will have to pay the higher income tax as a part of their income. But let us say the economy is going through this down period. Fine, it is facing some kind of downfall. Fine, so what is going to happen now? The government wants to stimulate the economy. Now the government wants the money to stay as a part of the economy. Fine. So what the government is going to do, if the government has followed the progressive income tax, what is going to happen? Those people, if their income has got reduced, what is going to happen as a result of it? Now they are going to pay lower income tax. Earlier they were paying higher income tax. So what is going to happen? The economy is going to get automatically stabilized under the boom period and under this down period. Fine. So this is what? This is nothing but this is a type of automatic stabilizer. Let me ask you another question. If I ask you that is unemployment insurance a type of automatic stabilizer or not? Tell me, is unemployment insurance a type of automatic stabilizer or not? Right, yes or no? Right, yes or no? Is unemployment insurance a type of automatic stabilizer or not? What do you mean by unemployment insurance? कि जो लोग unemployed है, जो लोग बेरोजगार हैं, जैसे वो पहले तो कुछ लोग हैं जिनके पास एम्प्लॉयमेंट है, अब जैसे वो अनएम्प्लॉयमेंट बनेंगे, जैसे वो अनएम्प्लॉयड हो जाएंगे, उन्हें क्या मिलेगा? हम गवर्नमेंट उन्हें पैसे दे देगी. इससे क्या हो गया? इकोनॉमी ऑटोमेटिकली स्टेबलाइज होगी. द पीपल हु वर गोइंग टू फेस द पॉवर्टी, who were going to face a number of circumstances, now the government has provided the insurance, the government has provided some kind of minimum, not the maximum but the minimum financial support to them, so that basically they can sustain their livelihood for a maybe for a temporary period of time, depending on the policy of that certain XYZ government. Fine, XYZ country or nation. So that is what the employment insurance is. So what is unemployment insurance? Unemployment insurance is also a type of automatic stabilizer, and since it is incurring cost to the government, so it is a part of the fiscal policy. Fine. So that is why it is up at, so if I remove the progressive income tax and if I add unemployment insurance, then that can be also the correct answer. Why fixed interest rate is not the correct answer? Because though fixed interest rate seem to be an automatic stabilizer, but the question is asking about the fiscal policy. But fixed interest rate is not a part of fiscal policy. Fine, it is a part of, I would say, interest rate primarily get dealt under the monetary policy, and that is why A cannot be the answer to this question. ठीक है. और बाकी अगर मैं FDI की बात कर दूं या फिर गवर्नमेंट बोरिंग की बात कर दूं, तो ये सब चीजें ऐसी है. एक्सपोर्ट सब्सिडी की बात कर दूं, they are not automatic stabilizer. The government have to intervene time to time. Fine. So that is why C is going to be the answer to this question, and I have added the explanation over here. You can read it later on. I have just explained the same thing. Fine. So I hope it is clear to you, and you can let me know in the chat box or in the comment box. And before we end the session, let me also tell you that if you are preparing for PFRDA or IFSCA exam, how can EduTap help you? So basically you can go to a website edutap.in. Under the courses section you can go to PFRDA Grade A courses, and over here you can see that basically we provide two types of courses. Fine. So the first is a single course that is there, which includes the gold course and the silver course also. Gold course includes the content for both phase 1 as well as for phase 2. Whereas if you talk about the combo courses, let us say you want to prepare for PFRDA and IFSA simultaneously in order to deal with their syllabus. So in that case you can go for the combo course, over where we are providing, I would say, again you can see the course that is there for both phase 1 and phase 2, and this one is for the phase 2 only. So if you think you are already comfortable with phase 1, then you can go for this second course and you can go for the first course only, fine, which is a type of silver course only. And currently 70% off is running on our website, so you can apply this coupon code and eventually that is going to help you. So that is it from my end, and if you have any question, any doubt, you can ask it. Any question, any doubt, any query that you would like to ask? Okay, so thank you so much. Now, with your permission, I'm ending the session, and now we will meet tomorrow. I will bring another 15 questions. If possible, I will try to bring 20 questions also, and we will have a good time ahead. Fine, so that is it, and thank you so much, and all the best.